Oil is the most heavily traded commodity on Earth. From $1.5 to $2 trillion is traded for oil every single day, and that's over 10 times the volume of gold. And the Strait of Hormuz conflict is turning the oil markets upside down for the foreseeable future. While everyday investors are waiting for the Strait of Hormuz to reopen and close and reopen again, institutional money is looking at all that damaged infrastructure. They're looking at what's happening in the Persian Gulf, and they're seeing it not as a temporary traffic jam, but as the US taking out the knees of the low-cost OPEC producers. Even with emergency pipelines running at maximum capacity, 14% of the world's daily oil supply vanished overnight. Insiders are trading oil minutes before every single White House tweet, and the financial news outlets are saying again and again that oil production is going to snap right back and the cost of living crisis will come to an end. But is that true? It's been months already. Who can we trust? How much capacity was permanently taken offline for years? So let's look at the charts. Middle Eastern oil facilities didn't just stop shipping. Key production fields infrastructure was severely damaged, and rigs suffered pressure drops, reducing output. That means even when the strait opens, up to 3.5 million barrels per day of output are gone for years. Who steps in to fill the global void? Is it Russia, Norway? Well, it's not who you think, because we believe that these profits are going to land directly into North American energy companies. To understand why Wall Street is quietly accumulating US and Canadian producers, we have to break down three key financial trends. First, let's talk volume. The Strait of Hormuz isn't just a waterway, it is the throat of global energy. 20 million barrels a day used to pass through every single day. And when it locked down, or it was cut off, pipelines have tried to reroute this oil through Saudi Arabia and the UAE, but they've only managed to ship about 6 million barrels a day. And that leaves a gaping hole of 14 million barrels per day that is not being able to be shipped to markets. That's more than the total daily production of the United States. The US knows the Middle East has a cost advantage per barrel at $5 per barrel or less to pull oil out of the ground, and that Texas Permian crude costs about $12 per barrel, and Alberta tar sands sits near $15 per barrel. But watch what happens when you add logistics, wartime security premiums, and insurance on top of the basic costs. Shipping a barrel out of the Gulf now carries an extra $10 to $12 per barrel just for insurance premiums. Suddenly, Middle Eastern oil isn't that cheap anymore, and their total all-in costs for everything have shot up to nearly $48 per barrel, wiping out their economic moat and putting West Texas and Alberta oil back on an even playing field. This cost breakdown explains why institutions are so bullish on North American oil. Back in 2016, OPEC controlled over 53% of the crude oil production, but when you look at where they're headed for 2027, 2030, and beyond, you might be more concerned because North America has gained a lot of efficiency in their production, and the eastern supply that has been destroyed is going to be shifted to the North American energy producers. The US and Canada are going to capture a combined 33% of total global market share for oil in the near future. And the UAE has decided to officially leave OPEC before it crashes. So what are we looking at for insights? You've probably heard analysts say, well, high oil prices will cause a global recession. But this conflict has been going on for months and months already, and we've seen prices start to trick up, but economies are still going strong. So the question is, when it ends, which oil stocks are going to crash and which ones are going to start continuing to gain over the near future? And we believe that the US production is where it's at because the US, this has been their plan the whole time. North American energy producers, they don't need $120 a barrel to make massive profits. The sweet spot for US shale and Canadian heavy crude is right where WTI and Brent are stabilizing, around $75 to $85 per barrel. That's where they can make profit. At $80, WTI companies like Diamondback Energy and Canadian Natural Resources are yielding 12 to 15%. Over the last 5 years, these companies have paid down debt, streamlined operations, and locked in contracts for pipelines where they can deliver their oil to international markets. They are now competitive producers. And look how this is finally shifting production. ExxonMobil and Chevron alone control over 7.5 million barrels of oil every single day. And up north, the Canadian tar sands and Canadian Natural Resources, they operate these massive oil fields with enormous reserves, with almost zero exploration costs. They can maintain their output for the next 30 years in the Alberta. While the Middle East fields face physical repairs and North Americans' energy juggernauts are starting to collect this cash and they're funneling it straight back into dividend and stock buybacks. So how do we trade this actual shift? Here's our breaking markets playbook. Scenario 1 is to trade direct North American oil producers, single stock trades. If the Hormuz bottleneck remains unresolved for another quarter or another 6 months, global refiners will pay a premium for secure onshore North American crude. And you want direct exposure to the low cost producers in North America. Here are our 3 stocks on our watch list right now. The first is Diamondback Energy. They are ticker FANG, and they're the premier low-cost Texas Permian-based pure play. And they have a cost per barrel around $40. Second one is, as we mentioned, Canadian Natural Resources. They are the undisputed king of the Alberta tar sands, and they have reserves for the next 30 years. The third is Energy Transfer LP, ticker ET. They are a midstream company that operates the pipelines and other infrastructure, and they're basically collecting a toll on all the oil that is being sent to the Gulf Coast refineries. Scenario 2 is broad institutional energy. If you want low-cost, basket-level exposure to capture this shift to North America, then here's 3 ETFs that we can take a look at and follow over the next 6 months. First one is the Energy Select Sector, SPDR, ticker XLE. They capture large cap US giants like Exxon and Chevron. Second one is the Alerian MLP ETF, ticker AMLP. They yield over 7% and they're focused mostly on infrastructure and pipeline companies. And the third one is Vanguard Energy ETF, ticker VDE. It is heavily weighted towards North American energy producers. Now, securing crude supply is only one source of energy, and we know that energy demand is going to be increasing in North America due to AI. But a second source that is key to this AI data center development is natural gas. So subscribe and ring our bell for the next video where we explore global LNG futures demand.